Bangla Pulse.
For the first time in nearly half a century, Bangladesh has completely torn up its old tax rulebook and written a brand new one. We're talking about the Income Tax Act of 2023. And let me tell you, this is not just some minor update, it's a total overhaul that changes how pretty much everyone, from you and me to the biggest corporations, has to deal with their taxes. So, what's actually in this thing? And why the massive change right now? Let's break it down. So, why the huge shakeup? Well, it all comes down to some pretty serious legal drama. You see, the country's entire tax code, the 1984 Ordinance, was created under martial law. Fast forward a few decades, and the Supreme Court basically ruled that laws from that era were unconstitutional. And just like that, poof, the legal foundation for the entire tax system was gone, declared void. I mean, just imagine that for a second. The entire legal basis for collecting income tax in the country just vanished. That created this massive legal vacuum. So the government had to move, and they had to move fast, to build a completely new, constitutionally sound system from the ground up. And that's exactly where the Income Tax Act of 2023 comes into the picture. All right, so here's our game plan for this explainer. First, we're going to dig into the dramatic story of why this new law was even necessary. Then, we'll learn the lingo, the official tax dictionary. After that, we'll look at what the government actually considers income, cover the super important dates and deadlines, and finally, we'll meet the authorities in charge of the whole shebang. Okay, first up, the origin story. And this isn't just about a simple update to an old law. Oh no, this was a fundamental replacement, born out of pure legal necessity. You can literally see the dominoes fall on this timeline. It all started back in 1984 with that law passed under martial law. Then bam! 2011 rolls around and new constitutional amendments basically pull the legal rug out from under it. The final blow came from the Supreme Court, which made it official. The old law was void. That lit a fire under everyone to create a proper replacement, which led us right to the 2023 Act. So what was the official mission statement here? Well, according to the ACTA's own introduction, it's not just about filling that legal gap. The goal is to modernize the whole system in a, quote, time-befitting manner, expand who and what gets taxed, and, this is a big one, establish much greater financial discipline across the entire country. All right, next section. Before we get any deeper, we've got to learn the lingo. Like any major law, this act has its own specific language. And trust me, getting these key terms right is absolutely essential if you want to understand how the whole system actually works. First word up, assessee. I know, it sounds a little intimidating, but it's actually really simple. An assessee is basically anyone who's on the tax authority's radar. If you have income that can be taxed, if you have to file a return, or if you're part of any tax proceeding, congratulations, you're an assessee. It's just the official, fancy term for a taxpayer. Okay, this next one is super critical. Are you a resident or a non-resident? Because this one little word can totally change your tax obligations. The main rule is pretty simple. If you're in Bangladesh for at least 183 days in a year, you're a resident. But there's also a second, kind of tricky rule. If you're there for 90 days in 1 year, and you were also there for a full 365 days over the last 4 years, you also count as a resident. If you don't fit either of those, you're a non-resident. And one last key term for now, the income year. Think of this as the 12-month period where your finances are put under a microscope. For most people, this is from July 1st to June 30th. You take all the income you made during that period, and then you report it when you file your taxes during the next year, which is called the assessment year. So we know about the time frames, but what about the money itself? What does this new law actually count as income? Well, as you're about to see, the government is casting a very, very wide net. The definition of income in this act is, well, it's huge. It's not just your salary. It's any profit, any gain from pretty much any source you can possibly imagine. And get this, for calculation purposes, the law even includes any loss of income. Wild, right? And then there's the ultimate catch-all phrase. Income is anything the Act says is income. That gives the authorities a ton of flexibility. And that brings us to a really important distinction. Income versus total income. Think of income like all the money you pour into the top of a big funnel. But total income is what comes out the narrow spout at the bottom, after all the official rules, deductions, and calculations have been applied. That final number, Total income is the one that really matters. It's what you actually pay tax on. All right, let's get practical for a minute. Enough with the definitions. One of the most important things for any of us to know is when is everything due? So under this new law, when exactly is tax day? Well, it's not a one-size-fits-all answer. It really depends on who you are. For most of us regular individual taxpayers, the magic date is November 30th. For companies, it's a bit more of a formula. It's the 15th day of the 7th month after their financial year ends. And hey, if you're an individual who is living abroad, your clock starts ticking the moment you get back. You've got 90 days to get it done. So, let's just hammer this home. For the vast majority of individual taxpayers, if you only remember one date from all of this, make it this one, November 30th. Put it in your phone, circle it on the calendar, do whatever you gotta do. That's the new annual deadline to get your tax return in.
Okay, for our final section, let's pull back the curtain and meet the cast of characters. Who are the actual authorities responsible for making sure this new law is followed? The Act lays out a pretty clear hierarchy.
Just think of it like a pyramid. Right at the very top, you have the big boss, the National Board of Revenue, or NBR. They set the strategy. Below them, you've got chief commissioners who manage big regions. Then you have commissioners running specific units. But the people you, as a taxpayer, are most likely to interact with, that's the deputy and assistant commissioners. They're the ones on the front lines, actually assessing the returns. And finally, you have inspectors out in the field supporting them.
Now, within that structure, you've also got these key specialized offices. There's an inspection wing, which is kind of like the system's own quality control team, looking over everything and suggesting reforms. Then you have the Central Intelligence Cell. Think of them as the detectives hunting for tax evasion. And of course, a training division to make sure all the officials know what they're doing.
So what happens if you think the tax office got it wrong? If you disagree with the decision? Well, the good news is there's a clear process for appeals. Your first stop is the Commissioner of Taxes for Appeals. If you're still not happy with the outcome there, you can take your case to a higher, more formal body, the Taxes Appellate Tribunal. So let's zoom out. What's the bottom line here? The Income Tax Act of 2023 isn't just a new law, it's a fundamental reset. It was born out of a legal emergency to replace a system that was declared void. And its goals are crystal clear. Modernize, expand the tax net, and bring a whole lot more financial discipline to the entire economy. Look, there's no doubt that this new act is a massive legal achievement. It creates a modern framework for the 21st century. But the billion-dollar question really is this. With all its new definitions, its new rules, and new authorities, will it actually make the tax system any simpler or more transparent for the average person? Well, that's the big question, and I guess only time will tell. All right, let's talk about something that can feel, well, a little intimidating. Bangladesh's income tax law. Today, we're going to slice right through all that complicated legal language. My goal is to give you a super clear, straightforward guide to what you actually need to know based directly on the law itself. So here's the game plan. First, we'll build the foundation. What's the basic idea behind the whole law? Then we'll figure out what the government actually considers taxable income. After that, we'll get into the really crucial difference between being a resident and a non-resident. Then we'll look at the penalties, and trust me, they're steep. And finally, we'll wrap up with some special rules that apply just to companies.
You know, at the end of the day, the entire massive law really just boils down to this one simple principle from Section 18. Taxes charged on the total income of a person. Simple, right?
Well, it sounds simple, but as they say, the devil is in the details. So let's really dig in and see what the law means when it says total income, because how they define that one term changes absolutely everything. Okay, let's start at the very beginning. What is the absolute core principle for how tax is charged in the first place? The law's starting point is this concept of total income. Think of it as the big number that everything else is based on. It's the total amount of money the government looks at within a specific time frame, the income year, to figure out what you owe. And here's something you might not realize. Income tax isn't just one single payment. Section 18 shows us it's actually a collection of different things. You've got tax that's taken right out of your paycheck, known as tax at source. You've got advance payments you might make during the year, minimum taxes, and even special taxes on things like a big capital gain or, hey, even lottery winnings. So now we know the starting point is total income, but the next big question is, what does the law actually count as income? Because believe me, not every taka that comes your way is treated the same. This is where Section 27 becomes so important. The basic rule of thumb is this: if the economic activity happens in Bangladesh, it's going to be taxed in Bangladesh. So, for example, your salary for work you did here is taxable, even if your company pays you from an overseas bank account. The same logic applies to rent from a local property, profits from selling an asset located here, and even money you make from e-commerce sales to customers inside the country.
Okay, this next part is a huge deal, because not everyone gets taxed on the same stuff. The law draws a massive line in the sand depending on whether you're considered a resident or a non-resident.
And this right here is the critical difference, straight from Section 26. If you're a resident, your tax world is, well, global. You're taxed on income from literally anywhere, whether it's earned in Dhaka or Dubai. But if you're a non-resident, your tax world shrinks. You only owe tax on the income that you actually earn or receive right here inside Bangladesh. It's a massive distinction.
Of course, any law needs to have teeth. So let's look at what happens if you don't follow the rules. And I'll tell you right now, the penalties for non-compliance are pretty severe. The law is really serious about employment rules. Just look at this specific scenario from Section 19. What happens if a business hires someone who isn't a Bangladeshi citizen, but they don't have the proper government approvals?
The penalty starts with a massive hit, an additional tax that's equal to 50% of your, get this, your entire tax bill for that year.
Or a flat taka 5 lakh. And here's the kicker. You have to pay whichever of those two amounts is higher. That's a pretty powerful reason to make sure all your paperwork is in order.
But if you think that's tough, the law gets even tougher when it comes to undisclosed assets held outside the country. Section 21 tackles this head-on, talking about what happens when they find offshore assets that you forgot to mention on your tax return.
And the process is very clear. First, the asset is discovered. Then, you get one shot to explain its source. If that explanation doesn't fly, the penalty is absolutely staggering. A charge equal to the entire fair market value of the asset. And if you can't pay it, the authorities can actually seize your other assets to collect that money.
Okay, let's switch gears for our final section. Let's talk about companies, especially the big ones you see on the stock exchange. The rules here are fascinating because they're not just about collecting tax. They're really designed to influence how companies behave.
Take a look at this. Section 22 is basically the law's way of encouraging companies to distribute their profits. If a publicly listed company decides to hang on to more than 70% of its net income, that's the red zone on the chart, then any amount above that 70% line gets hit with an extra 10% tax. The idea is to get that money out of the company's bank account and into the hands of shareholders.
It's a very similar story with Section 23, which is all about dividends. The law clearly prefers companies to pay out cash. So if a company issues more in stock dividends than it does in cash, or if it only issues stock dividends, the company itself has to pay a 10% tax on the entire value of that stock dividend. Again, the goal is to get actual cash flowing back to investors and into the economy.
So there you have it. We've covered the core of the law, from what actually defines income to the huge importance of residency, all the way to some really severe penalties. When you break it down, the principles are pretty clear. The only question left is, now that you know the rules, are you fully compliant?